All right. Well, thank you. Thanks for joining today. We're going to talk a little bit about the post-pandemic downturn. Before we get started, just wanted to say again, thank you very much for joining. I'm going to try to go through this relatively quickly. There's a lot of information today, and so first off, I'm just going to take it. This isn't actually an exact slide from the last webinar that we did in September. It was about the myths and realities of what was going on in the stock market. And so the interesting thing about this is really here's just kind of the bullet points. So there was what we talked about last time in September. There was a lot of narratives going on, and we talked about how there was a ton of leverage in the system. Leverage problems don't get solved quietly. Deleveraging is going to be painful. It creates investment opportunities. And we expected volatility to increase substantially as delevering battled with dip buying. Additionally, the Fed really had no tools to deal with the leverage problem, so we were expecting collateral damage, which basically takes us to where we are today, and we've experienced that quite a bit over the last, we'll call it 6 to 9 months. So now we'll get into the post-pandemic downturn and where do we go. So far since the markets peaked in 2021, there really has been no place to hide. Narratives have changed from where they were back in September of last year, and now pretty much all you hear every single day is talk about inflation and what that is and the narratives around that. What's happened is basically the pandemic and the policy responses that we had, both from the Federal Reserve and from our government, have really skewed economic, personal, and corporate data, making it very difficult to see what happened from that and what is actually reality. Now, the interesting thing is, as the Fed has stepped aside and started to raise rates, not continually pumping money in, we're actually starting to see asset prices begin to provide real insights into future expectations. And that's what we're going to focus a bit of today's webinar on. So first, let's talk about no place to hide. So basically, stocks and bonds have both sold off. And this chart here is a balanced portfolio, 60-40, 60% stocks, 40% bonds. And what's interesting, and here's the blue highlighted areas, is that actually the downturn right now for a balanced portfolio is worse than it was at the bottom of the 2008 financial crisis, down 23.5% as of June 14th versus down 21.1% back in 2008. In fact, we were about 21.25% in the lows of March 2020, but that was very, very quick. And this is a little bit of a different market. Now, the interesting thing about it is back in 2008, bonds actually worked as a buffer to stocks, and that's the way it should be. So in essence, a 60-40 portfolio, when stocks go up, bonds go down. When bonds go up, stocks go down, and they balance themselves out, and you get a much smoother return. Back in 2008, when stocks sold off 50-some%, bonds actually held up, especially government bonds, and did okay. And that's why you only had a 21% downturn at the bottom in 2008. Now, here's a different picture, and which is basically today where we are. If you take the TLT, which is long-term U.S. Treasuries, so far as of actually yesterday, they were down 23.6% this year versus 21.18% for the S&P 500. So bonds have done nothing. In fact, they've actually performed worse. And this bar chart here takes a look at this 60-40 portfolio and how they performed for each quarter. So you can see back in 2008, and this large bar here is when Lehman crashed in the third quarter of 2008, down about 12%. Here is March 2020, is a little right around 10%. And here's the current quarter, which we're actually 14, getting close to 15% down for the 60-40 portfolio. So the interesting thing is traditional risk mitigation has not worked. And it's something that we've been saying for the better part of the year, is that it's going to be very, very tricky once the cycle turns to really avoid some of the downside. And we're seeing that right now in a 60-40 portfolio. So the question becomes, is it time to buy the dip? That's part of the reason why I put up this webinar. I get the question asked almost on a daily basis, which is very interesting to me, given the magnitude of some of the losses that we're seeing from investors and other advisors that are out there. Now, here's a quote by Baron Rothschild. It says, "The time to buy is when there's blood in the street," which basically means when everything is sold off, that's usually a time to buy because you're going to have much better returns going forward. So we look at it from a stock perspective. And one of the things you look at is sentiment. So when sentiment is very, very negative, it's usually a good time to buy. And when sentiment is very, very positive, it's usually a good time to sell. And so here's a couple of things. And this on the left here, this is the U.S. investor sentiment bullish readings. So they basically put out a survey and see how people are on the bullish side. Now, this goes all the way back to the late 1980s, and you can see where we are today. It's one of the lowest readings ever that we've seen from bullish sentiment. So that would be contrarian. That would be pretty positive. In fact, it's lower than where it was in March 2020. It's lower than it was in 2008 during the whole great financial crisis. It's lower than it ever was in the 2000 bear market. So it's pretty low. On the flip side, you have bearish sentiment, same type of thing. Now we are actually pretty high once again, one of the highest readings that we've seen since the late 1980s. And interestingly, it's about the same as it was in early 1990, nowhere close to where it was in the 2000 to 2002 bear market. And in fact, it's right where it was once in the beginning of 2007, right before the bear market, and then also in 2008 towards the end of the bear market. So if you just took one indicator like sentiment alone, you would say that stocks should probably rally. Now, it's our inclination that you can't just take one indicator. You need to combine that with some other things. And so one of the things that we found interesting, and it's both anecdotally from clients and prospects that we talk with, also just from walking around and hearing people talk about stocks and bonds, because it's become a bit more mainstream over the last couple of years, is if you've got very, very negative sentiment, which we just looked at, what we're seeing is the actions of people. They may be saying one thing, but their actions are completely different. So here's just an article or just a little snippet from an article back on June 14th. And basically it's undeterred retail traders piled into stocks as others fled. And if you look down here, that week they had purchased $1.6 billion and $1.8 billion worth of stocks over that week in the midst of the bear market. The average for the year is $1.4 billion. So if people are so negative, why are they continuing to pile into stocks? Because they're looking to buy that dip. And it's not the type of sentiment that you typically see at real generational lows. In fact, the other part of it, and this is the one that I find absolutely fascinating, is the worst funds are actually seeing the biggest inflows. So this chart here is actually, and there's a lot going on here, but I'll explain it because most of it's very, very simple what we're trying to look at. So this is the ARK Innovation ETF, which is run by Kathy Wood. This was the darling of the bubble. In fact, at one point, I think it was up 400% at the peak of the bubble. And people were piling in. The fact that, even at this point last year, just a year ago, every time she bought something during the day, because she releases her holdings at the end of every day, what she buys, what she sells, every time she bought something, it would be major news and stock would go up. Whatever she bought that day would go up 10 to 20% after hours. And what they invest in, ARK Innovation ETF, it's a lot of non-profitable tech that's looking 5 to 10 years out. No profitability in the near future, but supposedly innovation and potential for long-term growth. So the riskiest, most speculative stocks out there. What's fascinating is during this year, from January 1st to now, its actual return is down 59%. So 59% loss. This section right here is actually money flows. So when it's down, this kind of greenish area is money flowing out. So you can see for the first 5, basically from January to about Valentine's Day, there was some money flowing out. And then since then, if you see here, this is, you had a bit of flows in March, dropped a little bit, but money's still flowing in. And over the last month and a half, massive, massive flows into this particular fund when you've got a 60% drawdown. It's not something, again, that you typically see when investors are throwing in the towel and there's blood in the street. They're still trying to pick a bottom and looking for things to rebound relatively quickly. So one of the things that we like to look at is, there's always a lot of noise. There's narratives. We talked about that on our last webinar. You're hearing it now. In fact, if you turn on the TV, whether it's CNBC, MSNBC, CNN, even your local news, everybody's talking about inflation. So one of the things we like to do is step back and say, okay, there's a lot of noise. Let's just look at a long-term model. And so here's the long-term model for stocks. And this, I'd love to share this with people because it takes out all the noise. And basically what this does is this white line here is projecting 10-year annual price gains for the S&P 500. So the shaded areas, the vertical shaded areas are recessions. This red line is the long-term 8% historical average return of the market. This white line, horizontal line here, is a 0% return. So you can see for basically from the 1970s to basically 1999, expected returns for stocks for the next 10 years were always positive. For about 18 months in the dot-com bubble, we had a negative expected return for 10 years. Continued to go up. The worst it ever got was about 3.5% negative return, which is about what we saw from 2000 to 2010. Now you've got the bottom, great financial crisis, 12%. And then we go here, this has been the most fascinating. Basically, since 2018, this model has been projecting negative 10-year returns. And what's interesting is the only small blips, which lasted for a month, this was of positive expected returns going forward. This was December 2018. This is March 2020. And if you go down to, even with the correction, so 20-some% for overall stock, the overall indices, 40 to 50% for the average stock that's down from its highs. Even with that, we're still only down to projecting negative 3.76% per year return, which is just getting back to where we were projecting returns back in the peak of the dot-com bubble. So this is just a way to look at it and say, okay, yeah, we felt some pain in the equity markets, but if you were just to sit today and just throw everything else out there and buy today, what would your expected return in stocks be? It would be negative 3.76% return. So stocks to us are still not quite attractive yet from just a buy and hold perspective. So what's interesting to us too is that when you think about everything that's going on, analysts are still very optimistic. So this chart here is the white line is expected margins for the overall S&P 500. And these are estimates from analysts. So you can see, they dropped from 11% in the peak in 2000 to the bottom of about 8%. So about 3% reduction in operating margin. Then here's the bear market in 2008, 10 down to a little less than 7, a little over 3% reduction. They moved up. You had a 2% drop in the March 2020 correction. Now we've moved to all-time highs. So basically, even with a 20% correction, more than 20% correction in stocks, you've still got operating margins that are expected to be 13.2%. All-time records. I mean, dwarfing anything we've seen over the last 22 years of expected margins. And this is at a time when we're talking about hiring issues, we're talking about inflation pressures, we're talking about an economy that there's an argument on whether it's going to slow, but how slow is it going to be? Is it going to be a soft landing or a hard landing? And yet we're still projecting all-time record margins. We would feel a bit more comfortable if these estimates had come down. It's probably more realistically soft landing 11 to 12, hard landing 9 to 11% operating margins. So even though we've had a 20-some% correction in the stock market and things look cheap, we haven't had estimates really come down yet to really reflect what's going on in corporate earnings. So, that's just a little bit on the equity market. Now we're going to talk a little bit about the bond market. Again, we're going to step back and look at long-term models. So this model here is actually very, very simple, and this goes all the way back again to the late 1980s. And it's fairly simple. you're basically taking the U.S. 10-year yield and you're subtracting out the dividend yield of the S&P 500. The idea behind this is to say, if you're an investor and you have two opportunity sets, you can either buy stocks or you can buy bonds. If stocks are yielding more than bonds, then you're going to get a better return, so you buy stocks. If bonds are yielding more than stocks, then they're going to give you more income, so you're going to buy bonds. Now, what's interesting is, this is when interest rates were really high and it precipitously came down. What's fascinating, though, is as you get this, basically from the bottom of 2000, the 2000 bear markets, around 2003, there was about a 2% difference between bonds and stocks. They moved up a little bit, and then since that point, the great financial crisis, when the Federal Reserve came in, quantitative easing, bailouts, basically the Fed getting their hand in everything, it's moved between about 2% and, we'll call this 1% difference. So down here, when you see the red, that means stocks are cheap relative to bonds. Buy stocks, sell bonds. When it moves up here, basically bonds are cheap relative to stocks. Buy bonds, sell stocks. So you can see this is the bottom in 2000, and this is March 2009. This is the summer of 2011. This is early 2016. This is March. This little blip here is December 2018, and this is March 2020. I'm sorry, this is 2000. That would be 2000. This is March 2020. So in every single one of these instances, great buying opportunity, great buying opportunity, great buying opportunity, great buying opportunity. And these, great buying opportunity for bonds, and here we are at 1.5%. So from our perspective, even though the stock market has sold off, because the bond market has sold off even worse, to us on a relative basis, bonds are actually a bit more attractive than stocks at this level, because their expected return going forward, even if you held for 10 years, you're going to get 3%. Leave inflation out of it. If you just, I don't know if it's going to run at 8% still, or if it's going to drop down to 2%. I don't think anybody really knows where inflation is going to go. But if you're just to buy a bond today, you will get 3% on your money. And if you buy stocks and they go nowhere, you're going to get, you're going to get a lot less than that, 1.5%. So just when talking about bonds, another way to look at it is look at relative value. And so when you're looking at bonds and you're comparing one to one, a higher yielding bond is perceived to be more risky than a lower yielding bond. So when you look at it from a government perspective, this goes all the way back to 2008. At the current time right now, Chinese bonds are yielding less than U.S. Treasuries. So are Chinese bonds really less risky than U.S. bonds? And additionally, if you're a foreign investor looking at, let's say you're a European investor and you can invest in a U.S. Treasury bond or a Chinese bond, I think most of them would say, and you're going to get more yield in the U.S. Treasury bond than a Chinese bond. I think most of them would go ahead and say, I'm going to buy the U.S. Treasury because we don't know what, I don't know if what the China's putting out there, if their numbers are real. And I don't know if I can trust it. Whereas most people, I believe, think that U.S. Treasury is, for the most part, is trustworthy. So you look at that and you'd say bonds on a relative basis should be getting some type of demand simply because they actually offer a better return than other government bonds that are available. So we talked a little bit about equities and blood in the street, and you rarely ever hear that about bonds, because you know what, bonds are not that exciting. You rarely ever hear it. But with inflation that's been running rampant, and the Fed, everybody knows they're going to start quantitative tightening, so they're going to sell their long-term bonds. Investors have been selling bonds at a record pace. So we talked about how even though investors in equities are saying that they're very, very negative, yet they're piling billions of dollars into the stock market on a weekly basis. They're buying the riskiest funds. And at the same time, this is from June 16th. The headline on my Bloomberg, here's two of the top three headlines. U.S. high-grade bond outflow streak reaches the longest on record. And muni bond funds see the third largest weekly outflow on record, with the other two also coming this year. So people are flooding out of bonds. They can't get out of bonds fast enough and they can't buy the dip in stocks fast. And this just doesn't quite make sense when you go in and you dig in a little bit deeper. So another thing we like to look at when you're talking about bond yields is, where does, there's always some return to the mean at some point in time. So here is going back, and again, I keep using around the same time period, but the mid 1980s to today. Here's the bond yield. So again, when bond yields go up, bond prices go down. When bond yields drop, bond prices go up. There's just a simple regression for the last 35 years, 30 plus years. This middle line is the average. Then you have +1 standard deviation and 2 standard deviations to the upside, -1 standard deviation, -2 standard deviations to the downside. So you don't have to be a financial analyst or have all these credentials to look at this chart and say, wow, for the last 30 some years, bond yields have stayed within this range. When they got too low, they rose. When they got too high, they fell. When they got too low, they rose. It drove back and forth almost the entire time. And it makes sense because statistically, 95% of the time, things should happen within 2 standard deviations. Now, what's fascinating is this runaway that we've had basically for much of this year. Yields should have been capped, if it stayed in this range, should have been capped at 2%. Now they're up to 3.44%. Our view is that, okay, I'm not sure where yields are going to go over the next 10 years. I don't know if we're going to end up, the equilibrium is going to be 6%, if it's going to be 3%, if it's going to be 2%. But I do know that it's going to be very difficult to break a 30-plus year cycle and go up and just continue up unabated without something happening or something bad, if it hasn't happened already. So our view is that before we get to 5 or 6% yield, we think that this yield is going to have to check back and at least test this breakout area of right here just happens to be about 2%. Now the interesting thing about that is if yields on the 10-year drop from, and again this is from the middle of the month, June, so yields have come back a little bit. But if they were to go from 3.4% down to let's say 2 or 1.75 or even 2.1, somewhere in this vicinity, you're talking about 20 to 30% upside in your bonds. And I don't think most people realize that, is that you could potentially see that in your bond portfolio. And so for us, just to check back, just to get back to some type of mean reversion would imply 20 to 30% upside. And even if you're wrong, it goes to, let's say, 4%, you're talking about maybe an additional 5 to 7% downside. So the risk reward for us in bonds actually seems pretty favorable here. So one of the other things too is, we talked about positioning, we talked about sentiment, stocks versus bonds, long-term models, but let's go into some of the economics. One of the first things I talked about on the first slide was asset prices are starting to, because the Federal Reserve has stepped aside and price discovery is starting to come back. So on our last webinar, we actually talked about narratives and how they tend to be false and what you get fed from the Wall Street Journal or CNBC. A lot of the times, again, they're businesses and they're trying to, whatever is the hot topic, they're going to push that hot topic all the time. And that is not necessarily indicative of what's really going on. So here we're going to talk about inflation peaking. So one of the areas that was supposed to be most affected by the war in Ukraine was wheat prices. We heard about it back when it first happened. You want to own wheat because Ukraine exports so much wheat, it's going to drive food prices higher. Now, we've seen food prices move higher, but here's the reality of wheat. This is the wheat chart. So going back to early 2021. You can see this major spike here. That is the invasion of Ukraine. Okay, now that spiked and it came back. And in fact, from that level to where we sit today, it's actually down 32%. So a 32% drop from its peak. And it stayed in this range. So it dropped down. Here's this white line again is the bottom of the range. Dropped down, tested this range, came down again. Didn't quite make a new high. It's actually breaking that level, which means that equilibrium is probably down in this level here, which would imply 40 to 50% downside. from where it was. Now, I don't know where it does going forward, but the simple idea that wheat and the war on Ukraine is going to continue to drive prices is just simply not reality. In fact, that's a pretty significant drop from the peak in what we've seen in wheat. Now let's take a look at another area, which is housing. So housing is something that everybody likes to talk about. And home prices have been up, mortgage rates are way up. But let's actually take a look at the commodity, which is lumber, which is a huge leading indicator for housing. And you look at this, I went back even a little bit further to 2018 because prices right now are the same for lumber as they were back in 2018. So it had been down for a while, didn't move too much. Now here's the drop during the pandemic, and then the rocket higher. And then it dropped, and then mid-2021, that was the peak. And it dropped, it rose again, and dropped to where it is. From the peak to where it sits today, almost 69% downside. From the second peak to where we are, almost 64% downside. So a couple of things. One, this is a huge input for housing. That has obviously peaked. I'm not saying that we can't have another run up, but this is pretty dramatic when you look at it. And you know, for people that don't look at the economics and just like to look at charting, it is actually showing, especially if it breaks below this level, you've got one shoulder, new peak, second new high, and it keeps coming back to this level. If it drops below here, drops below this level it's been at for 2 years, that would signify that that lumber prices are probably going to continue lower. But in any case, even if it doesn't, you can't look at this and say that lumber prices are way too hot and they're going to continue to drive inflation because it's just simply not reality. The last one I'm going to talk about is a leading indicator for global growth, which is copper. As you can see, coming out of the pandemic, you can see a steady increase in copper all the way to mid-2021. Then you've got this basically trading range for the better part of the last year and a half. It gets down to around 400, went up to about let's call it 475, down 400, back up, dropped, looked like it was going to start to break out, and now it started to come down. So this was that level, that range, again, 400, which just started to drop down and break down into this area. This is going to be very important to watch going forward. And you're talking about 20% downside from its peak. These things, commodities, they're volatile, but when you actually look at it, and it's not just, I chose these 3 areas because I'm not going to go through 45 different charts, because one is growth, one is housing, and one is directly related to the war. You're seeing the same thing, whether it's aluminum, tin, nickel, lead, all sorts of different prices. And then just recently, the last couple of days, oil and natural gas that are basically saying some of these input costs are starting to peak as far as inflation is concerned. So we talked about this, and we talked about different asset classes and what they're telling us about what's moving forward. One of the best indicators for bond yields and growth has been the copper to gold ratio. So this is it from basically 2019. When it moves up, basically copper is outperforming gold. When it moves down, gold is outperforming copper. The simple idea is when copper, which is very, very economically sensitive, when it goes up relative to gold, that means the economy is accelerating. When it drops, the economy is decelerating. Simply, another way to look at it too, when it goes up, inflation goes up. When it goes down, inflation goes down, and yields should follow. This has been traditionally a very good leading indicator of where bond yields should be. So look, peaked in mid-2019, dropped through the bottom of the pandemic, spiked dramatically through the early part of 2021, and actually led interest rates by about 6 to 9 months for their dramatic rise. Now, what's interesting is even since the beginning of 2021, similarly, it's stayed in the range, right around five times that range, and just recently, so tested, moved higher, tested, moved higher, tested, moved higher, tested, moved higher, and now just recently it broke down. I believe that it's going to continue going this way, which means that in the next 6 to 9 months, you should see a peak in interest rates, and that, depending on where growth really winds up, this should move lower and yield should move lower and bonds should do better. Now, if that's the case and we move from an inflation scare to a growth scare, bonds should do well and stocks should not. So rather than moving in the same, I think they will decouple again sometime in the near future. So we've been talking a lot about bonds, how we think they're a good buying opportunity at this point in time. However, what we're suggesting is not to buy any type of bond. And the reason for that is, and we see this across our industry, is especially as an advisor, when someone's paying you to invest in your bonds, you're just trying to get as much yield as you can. And I've seen it in the past where someone will sit there and say, okay, if I can get 3% in treasuries, I can get 4.5% in corporate bond, or I can go into high yield and maybe get 6%. Now, the problem with that is that in a real hard landing type scenario, these corporate bonds are actually going to provide very, very little protection versus a government bond. So this chart here is actually just the high yield spread. And the idea there is that the spread is relative to government bonds. So here, just recently, it was 2%, basically at the peak. And now it's about 5.5%. The idea is that when the economy starts to contract and credit becomes a problem, then if you're lending money to a distressed company, so let's just say Royal Caribbean, so a cruise line, I want to get, let's say, 10% on my money if I'm going to lend to them because they might go bankrupt, versus if I'm lending to a company like, called Verizon, which is relatively stable, I might only require 4 or 5% on that. And so the difference between that is the spread. So this chart here is basically looking at the riskiest bonds and their spread. And you can see, again, these red shaded lines are recessions. So previous recession, about 13% spread. 2000, you got about 8 to 9% spread. 2008, we got all the way up to a 19% spread. Even in the growth scares of 2011, 2016, we were almost at an 8% spread. March 2020, a 9% spread. Right now, we're still only at a 5.5% spread. So if you get a soft landing, I would say credit spread's still widening. If you get a hard landing, that could end up somewhere between 10 and 12%. So even if interest rates go down and you're owning corporate bonds, you may still lose money. You might as well be in a stock at that point in time. So even though we're advocating for bonds as a buying opportunity, we're still looking at that as actually owning government bonds, whether that be very, very high grade municipals or just simply treasury bonds. So one of the pushbacks we get right now, because, and again, we just started this view recently about owning bonds and not stocks, is, well, how can you own bonds? Because the Federal Reserve, everybody knows the Federal Reserve, they just hiked 75 basis points. Inflation is running strong. They're going to continue to hike. Everybody knows they're going to continue to hike. Well, our point is that the market is so far ahead of where the Fed is that the Fed is basically just playing catch up, and it really doesn't matter what they do. So I'm going to explain that with this chart. So this is basically, what this is the U.S. Treasury curve, which basically starts here. This is a 1 month, what you get on 1 month bonds here, to all the way out to 30 years, the yield on that. So 30 years, you're getting 3.4%. 1 month, you're getting under 1%. Now I circled this red line here is where the Federal Reserve is. So it's between 1.5 and 1.75. This is the effective Fed funds rate right now is the red line. Here's the 2-year Treasury, just around 3%, where we are today. So the Federal Reserve can basically hike another 1.25% before it even gets to the 2-year Treasury with the market. So there's a lot of flexibility. The market has already priced this in. Now, why is this important? Because the reason why the Federal Reserve hikes interest rates is to slow inflation. And the Federal Reserve has an effect on short-term rates, not necessarily long-term rates. So what does that mean? Well, if they're hiking to lower inflation, then future inflation expectations should come down, which is reflected in the long-term bonds. And this is why you get inverted yield curve. So as the Fed continues to hike, these prices, the general assumption is that these rates are going to continue to go up as well. But what happens is the short-term rates go up very, very quickly, And these actually stay stable and start to come down as they predict the next recession and then cutting of interest rates. So it's our view that the long-term bonds, because they're down 23% this year, have already priced in the majority of the Fed tightening cycle. So they're just trying to play catch up, and it really doesn't matter what they do at this point, to an extent. So the next point, and this is one of my favorite charts out there, and it's done by McClellan Financial, which basically compares the Fed funds rate, which is the black line here, to the 2-year Treasury, and how it fuels bubbles and causes crashes. So when the 2-year Treasury is well ahead of the Fed funds rate, it causes a bubble. So here you can see the late mid-1990s, well ahead of the case. It dropped here just for a short period of time in 1998. They stayed low. 2-year Treasuries went much faster. So this and this caused the 1990s tech boom and bubble. Then they hiked too much. 2-year came below. Oops, too tight. They had to catch back up to the market. You have a major recession. Then they stay, from here basically all the way to here. So for 3 or 4, actually probably 5 years, they stayed too loose. They tried to catch back up to the market. They eventually did. Oops, this is the housing bubble. This caused the housing bubble. Oops, they went too far. They've got to catch back up to the 2-year and drop. Here's the next bear market and housing crash. So keep rates low. Now, what's fascinating about this is we've basically, because they kept the rates so low, this is fueling the everything bubble. We called it for 2-3 years. Again, probably too early, but while we looked at prices saying we are absolutely in a bubble, this is a bubble, this is a bubble, and it's everything. It's not just stocks. That was fueled by this easy monetary policy. They should have been hiking rates much earlier than they did back here. Now it did. COVID crashed. They had to cut rates again. And what's fascinating is because of the pandemic, it dropped. 2-year rates shot higher. And look how far behind they are to try to catch up. When it's really going to be a problem is when green crosses black, green crosses black, green crosses black. When that happens, when the 2-year starts to come down and this comes up, that means they've gone too far. That's when the real crash is going to happen. So as far as Fed funds right now, we don't think it matters. They've got plenty of room to catch up. It doesn't really matter what they do because the damage has already been done by waiting way too long to start hiking rates. So talked about peak inflation. Now, a lot of the narrative right now has been that, well, stocks are down because inflation is high and bond yields have gone up. And there is some truth to that, but you have to look a little bit past the narrative. It's actually our view that stabilizing yields should start a bear market rally. But this is not going to be the start of a new bull market. Now, why are bear markets important to understand? Here, this is a chart of the S&P 500 in the 2000 to 2002 bear market. So as you can see, prices over the long term, this 3-year chart, they dropped and dropped and dropped. And, I think eventually they were down, over 50%. However, in the meantime, you had 11%, 12%, 10%, 22%, 26%, 25% rallies. Now, the traditional bear and bull market is 20%. So, looking at this chart, you wouldn't consider this a bull market, or this a bull market, or this a bull market. But 20-some% is a pretty big move. And it happens in a very short period of time. So we're saying, and maybe it's starting right now, you're going to get 10, 15, 20, 25% rallies in a bear market. It's going to happen. And it's probably going to start from yield stabilizing because people think, oh, well, yields going up is what caused stocks to go down. So if yields stabilize and go down, then stocks should go back up. We're not sure that that's necessarily the case, but we do understand that that can start a bear market rally. Now, it's also our view that you should sell the rally. Part of the reason for that is we added trillions of dollars worth of debt over 2 years. So hiking interest rates, it's going to be very difficult to engineer a soft landing with that amount of debt. And again, similar, this is the last bear market, 2000 to 2009, 10%, 13, 9, 25, 20, 27, 6 different instances. Bear market rallies would happen. Every single one of these rallies was a great time to be a seller. So for us, we would be looking to own bonds for longer and own stocks just tactically, or in for a bear market rally. So with that being said, one of the things we're trying to convey here too is that protecting principal matters. Reducing volatility in a portfolio matters. And I'm just going to give you an example of 2 portfolios. Here's portfolio A, portfolio B. Portfolio A is starting value of $1 million. In year 1, it returns 25%, 1.25. In year 2, it drops 40%, $750,000. Your total return is negative 25%. So you had a big up year, you have a big down year. You think, okay, well, maybe I'm not down too much because I'm up 25, down 40. Okay, so I'm only down 50%. Well, the reality is you're down 40 from a much bigger number. So your total return, you're actually down 25%. Just by reducing volatility, portfolio B, starting value is $1 million. You lose 5%, you lose 8%. So in year 1, you're saying, oh my goodness, I lost 5% while everybody was up 25. That's awful. And then year 2, oh my goodness, it's down. I was trying to be conservative, but I lost again. Down 5, down 8. You're only down 12.6% versus down 25. So when we're looking at the set of stocks versus bonds, we're not saying that there's not necessarily going to be more downside in bonds. That's completely a possibility. But we're just saying that, there is potential. It is a good hedge at this point in time with where interest rates are. That, yeah, you may lose another 5 to 10%, but you're not going to lose that additional 30 or 40, which is a possibility in stocks should we see a hard landing. And if we see a hard landing, we do think you're actually going to see positive return in bonds. So to us, whereas for the last several years with very, very low interest rates, bonds were pretty much worthless in a portfolio. At this point now, we do find them as a good diversifier and a good hedge and a good way to make some return for portfolios and reduce that overall volatility of the portfolio to set yourself up for the next bull market. The last thing too, I talked a lot about equities in general and bonds in general. There are some things because the markets have been down, even in stocks that are actually attractive. So even if the stock indices may struggle for a while, there are some bargains to be found. I'm just going to give you one example really quick. This is Verizon, right? Here's the price chart. Stock has done nothing. It's around 55. It's around 51 now. So maybe 10% downside in the year from a price perspective. You get a 5% dividend. So overall, you're down about 5% total. Not awful. But when you actually look at it, the earnings, you're trading at about a 9 multiple. And for a while, people said it's boring, they're not growing, they're not going to do anything, they're doing 5G, we're not sure about that. Every different narrative in the book. And I'm not going to say that we've been fans of Verizon, other than maybe for the last year or so. But when you look at it and you think about all the uncertainty that's coming with inflation, with interest rates rising, with the economy, whether we go into a soft landing or hard landing, not really sure. But one thing that I do know is that as far as your cell phone is concerned, no one is going to get rid of that. In fact, a month and a half ago, they raised prices. Verizon, AT&T, T-Mobile, they all raised prices. They're talking about raising prices again, and most people don't even realize it. No one's going to blink an eye if their prices go up 10 to 15% for their cell phones. Whether the economy is raging or doing awful, people are going to have their cell phones. So there's good visibility in knowing what they're going to earn. Not to mention the fact that if the market multiple is still 17 or 18, you're getting a big discount for something that will still be there, plus you're getting a 5% yield. To me, if you couple that with some treasury bonds and other stocks like that, there are boring stocks like this that are still relatively cheap. You can weather this storm and then buy things very, very cheap when we get to the other side for the next bull market. And that's where real money can be made. So here's our course of action. You can own cheap, boring, dividend-paying companies that are not affected by the economic cycle. Dell Verizon, we just went over that, other companies, other industries like that. You want to start buying treasury bonds as a hedge against the risk of a hard landing from the Fed. If they drive us into a recession, that treasuries will hold up and will buffer your portfolio from taking a downturn. Treasuries, in our view, have capitulated. They've taken the majority of their downside. You're getting a decent yield, especially relative to stocks, and has a much better risk reward going forward. Bear market rallies are going to happen. It's actually our general view right now that if we're not in the midst of one, we're going to see one probably within the next month. Simply because I'm not going to get into it right now, but there's a lot of different factors that go into why we think that can happen at this point in time. So our view is that when you have large sell-offs, I mean, outside of the last 2 days, we were down about 10% for the month of June. When you have big sell-offs like that, you want to reduce your hedges and your shorts during those large sell-offs. No matter what, you want to keep some cash available. When those sell-offs happen, avoid cash, buy some securities. As these bear market rallies happen, like we saw, anywhere from 10 to 20%, you want to sell your winners, raise cash, redeploy hedges, and short certain stocks into those rallies. That is the type of real active management that's going to be important to get through this bear market. I don't know whether the bear market is over today. My guess is it's not. I don't know whether it takes another 6 months, a year, 2 years. There's going to be a lot of moves in between there. But really actively managing risk, switching between different asset classes, selling things with a profit, not holding on to things that can lose another 30, 40%. That is what's going to be important. Yes, there's going to be, if you buy and hold good companies over the long term, you tend to do well. But at the same time, if you can avoid a 30 to 40% loss in the meantime and actively manage that risk, don't sell when the things are dropping like a rock, like they just recently did. You want to don't start chasing and buying when you get these bear market rallies. You have to be disciplined. You have to keep that real active management, and that's going to be very, very important. So I just want to say thanks. Thanks for joining. Thanks for joining the webinar. There's a few different things I didn't even touch on today, but it would have taken me 3 or 4 hours that are really important. One being the real estate cycle, 2, corporate earnings cycle, 3, business valuations, and lastly, in this volatile market, using options to enhance return and reduce risk. These are a few things we didn't get to touch on. If you'd like to, you can send me an email. We'll schedule a call, markpainter@everguidefinancial.com. Or as we get off this webinar, you'll be sent to a page where you can just go on, click on the calendar, and schedule a time. Thanks again for joining today. I hope this was insightful, and I look forward to hearing.